What's going on, everyone? My name is Nicholas Merton here at Dash, and today is September 9th of 2021. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, I want to dive into three major topics within the cryptocurrency space. First off, the aftermath of the sell-off on Tuesday. Where are we heading in regards to price? Are there any signs of confidence or fear that we need to be aware of? Second off, I want to dive into the conversation around the SEC's recent issues with Coinbase and their new lend program, because it does hit a bit close to home, and I want to share my thoughts as to why I personally believe that it's purely nothing but FUD here with no substance. And the last third component I want to talk about is a sponsored interview with Alchemy Network later on towards the end of the video. So stay tuned, guys. You won't want to miss it. All right, so let's go ahead and dive into the conversation, guys. The good news here is that over the past day or two, we've started to see really solid recovery across the board in a lot of cryptocurrency plays, right? Lots of cryptocurrencies back in double-digit green territory, starting to lead the market higher, recovering as we're seeing buyers come into the market. But I want to go ahead and focus on Bitcoin here, because Bitcoin here showcases yet again how important it is to step back on longer-term timeframes and look at areas of support and resistance, higher lows and higher highs, etc. Right? So when we take a look at the daily here, the daily close really only ended up being down around 11%. And I know that this sounds like a lot, but we've seen these kind of days on Bitcoin before, right? We've seen double-digit downward days for Bitcoin before, and or 1 or 2 day periods that have the same price range, if not worse. But overall, still much higher here in the grand scheme of things from where we were back here towards our support range back in July of 2021. So a little over a month and a half now, generally speaking, up almost in this case $16,000 from those lows, right? So things are looking quite well in the sense price, even as the pullback came through. What's really important to note here is a line that we've had on focus here, which are the kind of slightly expanding higher points of resistance here that possibly could have weighed down Bitcoin. And look at that, price coming down perfectly to rest as support on top of this key price level. So these are the kind of things we want to see if we are going to have pullbacks, no matter how quick or slow they are, that they come back down to these kind of support ranges. And generally, you can see buyers coming back in at the same range here, right? You can see buy side activity here on the second day coming in exactly at the support range here from August 18th. So again, not too doomsday-ish. And really, if you think about it, guys, just for like perspective's sake, to not get like too concerned or too worried about a sell-off, we're really about less than $1,000 gap from where we were back here on August 31st, right? So about a week, a little over a week's worth of price action down, right? Happens all the time in equity markets, happens in a variety of other asset classes. And then again, taking a look at the BLX chart, this is something I want to emphasize here, in the sense of like where we're going. Do I have any cautionary signs that, the markets are going to start turning over, or that we're done for in this case, that we are seeing a real bear market? To be honest, guys, no, I don't see any clear signs right now. This is nowhere near similar to the type of parabolic rise and clear, for example, we'll take a look at the 2-week here, right? The clear multi-week or multi-month period of red candles followed by small rebound. This is a nice substantial 6 weeks of green price action followed by a bit of correction that isn't even close to taking us down to where we were back here at around $29,000. Price action looks fine, and it's right about what we expect for price, as we talked about in our previous long-term video, our Bitcoin roadmap to 200K, as well as our other content about kind of where we are within the cycle and how high Bitcoin's price can go. We still have our target of around 200K, but the important thing that people don't account for is that we're looking at expanded time frames, right? We're adding another 12 months in this case, taking off the previous 11-month extension. Now we can take it to the monthly chart so you guys can see this here, right? We had a 13-month extension from the first to the second cycle and an 11-month extension. To put it smack in the middle and not be biased one way or the other, we can see here that an average out of 12 months would lead us right here to a nice, good, solid level above the white line at 200K, and it would be over a longer period of time. So what we need to have when we're setting these estimations, if we do believe that Bitcoin is going to go to 150K or 200K, we need to have reasonable time frame estimations according to history. And I know some people are like, Nick, you're absolutely bonkers or insane if you think that the cycle is going to go on that long. Well, guys, I bet a lot of people would say the exact same back here when we expanded the cycle 13 months, when we expanded it 11 months. And in this case, we're estimating that, just the conservative average here, according to history, is going to be 12 months. Yeah, it could be a little bit sooner. And heck, I'm going to tell you guys something, it could be longer in this case. Crypto markets are getting more mature. They're not making as higher multiples as they used to. And liquidity and price discovery is at a better position than it has been in the past. The only problem we have here with these violent upswings and also violent corrections is the excess of credit in the market, right? Now, that actually leads us to talking about our topic today, because I want to go ahead and talk about what I really think is the overarching problem here that the SEC is really focused on. So you've got this new case here with the SEC and Coinbase, Brian Armstrong going on a major tweet storm, being quite candid about his take, as they've been pretty confident in conversations with regulators as Coinbase has gone public and really been one of the first major public enterprises in the crypto space against the SEC, right? So let me just go ahead and give the quick rundown here, guys. I want to go ahead and just provide context from my understanding. I'm going to go ahead and candidly say I might be wrong on this, but you guys know I'm not going to try to spread misinformation. I'm going to be very realistic here. And for me, this is something close to home because we have an integrated partner, in this case Celsius, when this article actually covers Alex Majinski, who's the founder of Celsius, talking about this issue. We have Celsius Network as a partner within Digifox, the wallet I've created. And there are a ton of other wallets, a ton of other interfaces out there, right? So I do hold probably a little bit of an inherent bias, but I'm going to try to put that aside here to talk about what the SEC is saying and why I don't think it's their actual concern, okay? So let's take a step back. Coinbase, just like Celsius or BlockFi or Nexo, you name it, they want to offer a new crypto lending product. So this is the ability where you could, for example, maybe through a fiat on-ramp or through USDC you already own, deposit your USDC through the Coinbase Lend program. It'd be another service alongside the exchange services that it offers or its education programs. And this would allow you to earn 4% USDC interest every year. So you're earning interest on top of your tokenized dollars, right? It sounds great, right? I mean, honestly, it's not as high as Celsius, so the rates that we can offer within Digifox. And there's other apps out there that will offer more around 8 to 10%, but 4% fixed in this case is not only predictable, it's way beyond what you're going to get in a normal savings account. It's a great product, in my opinion. Someone could agree or disagree, and I think that that's the case of the SEC here. Now, the SEC, if we go through the conversation and we dive into some of their concerns, there's really two potential concerns that the SEC has with this Lend product. And it's kind of weird because they decided to send this kind of, I would say, kind of on the offense message and kind of scare towards Coinbase being the largest company, yet they haven't really done this with Celsius or with BlockFi or any other providers in this case, which is why it's a little bit shocking. But if you go through here, and you read through the article, Alex shares some really good thoughts, but to just kind of give the quick summary, there's two potential concerns here. The big one that the SEC kind of noted within their statements as of recent and with the conversations with Coinbase is that somehow Coinbase offering interest, in this case, interest income on stable coins in this case, right, that are resembling a one-to-one peg with real dollars, right, from a bank account. They're saying that this could issue towards being a security. This could be the issue in this case, that it is, in fact, Coinbase with a Lend program is offering a securities product. All right. Now, let's just go ahead and talk about the second issue, and then I'll dive into really what really defines a security, which is the Howie Test. The second issue that I think the SEC has brought up, or at least Gensler in this case is one of the new people who are stepping in here for the SEC, he's pointed towards the fact that stablecoins are an issue, right? We can see here, I have it highlighted here somewhere in the conversation that he talked about on a speech back a couple weeks or months ago when he was getting sworn in. He underscored that stock tokens, basically tokenized representations of stocks or synthetic positions might be securities. A stable value token backed by securities, so stablecoins, right? And other virtual products that provide synthetic exposure to underlying securities are subject to securities law. Now, I'm going to go ahead and just take a step back here. I think there is a valid argument and an important discussion that needs to be had when it comes to tokenized stocks. I'll stand back and say that. I think that's a very valid point, right? If you're talking about anything that's resembling probably around equities, right? Yeah, that's a conversation that needs to be had. But let's go ahead and talk about this real concern here and what we're really talking about, this Coinbase product that they're supposedly vehemently against and they feel violates potential securities law. You take USDC, which is backed by $1, right? So let's go ahead. Now that we understand that in this case, there's real one-to-one backing. They go through routine audits and general practices, some of the best standards in the industry. And I say that as in this case as another player who offers exchange services and a lend product. I'm not going to trash them out Coinbase. They're a great company, right? They do a lot of great things for the space. So let's go ahead and give them a fair routine analysis here. This lend product and how it actually functions is going to be taking your USDC, putting it into an interest-bearing account, and with that money, the reason you're getting interest is because you're lending it out to other participants on the market, okay? Just like a traditional bank, if we think about it. So let's go ahead and take a look through the Howie Test here, right? The Howie Test requires, in this case, in order to make sure something is not a security, that it meets at a minimum, in this case, does not meet any of these 4 requirements, okay? So first off, it is the money investment, all right? So just going ahead and talking about these, in this case, is it a general investment into something, right? Am I investing with the expectation of profits? And this leads to the second point, right? So if I'm investing in some kind of common enterprise, a company, for example, right? And as some people argue in this case, a token sale, right? This is the conversation the SEC had all throughout 2018, as they were a bit late to the party. They came in, they were starting to kind of put down the hammer with, I think it was, I forget his name and stuff, one of the previous SEC chairmen, but Jay Clayton, that's who it was, yeah. So they were coming in and kind of laying down the hammer because those might have been seen as potential profit plays, right? It was in a common enterprise, potentially. The money invested, in this case, is in a common enterprise, as we talked about, and the profit comes from the third party or promoter's efforts, right? Okay. So let's say, for example, if we take these 4 points here, right, we've got these 4 potential things that could deem something as a security. Right? An investment, expectations for profits. The money is coming into a common enterprise, right? A specific company in this case to fund some kind of initiative, or its profits come from third parties or promoters. Well, let's go ahead and think about this, guys. Let's say that 4th point, I'm a YouTuber, right? Let's say I go out and I talk about USDC. I could talk about USDC for weeks, months. I could say it's the greatest thing since sliced bread. Do you expect any profit from a stablecoin? I can't think of any profit you make with a stablecoin. How about an investment in a common enterprise, right? Are we investing in a company when we put our dollars into USDC? Does it give us shares in something, an expectation for profit, some kind of valuable ownership or voting rights? No, it doesn't give us any of that. Not at least to my understanding. And I've been using stablecoins for a very long period of time. Perhaps I'm missing something, though. So I think the way to summarize this, in the case in point, and I'm going to just kind of put the nail in the coffin, in my opinion, for why I think this is not the SEC's real concern. If you think about USDC, is it more akin to, in this lend product that we're talking about through Coinbase, is this lend product that Coinbase is offering, or USDC as a core, more like a stock or an asset in this case? It gives you voting rights, it gives you dividends, that gives you, in this case, some kind of asset exposure that's volatile and can be speculative in nature. Or is it more like a bank deposit? More like a savings or checking account? I gotta tell you guys, I'm betting more on the latter in this case. It's much more like a banking or savings product. Point in case, and that's not a security. Getting interest on dollar savings is one of the most core fundamental aspects of personal finance, and it is in no way a security from general interpretation. You wouldn't go to a bank and say, hey, yeah, you guys have a banking license, but you need a license to trade or issue securities for allowing for deposits. It doesn't make sense. And I think the reason why the SEC and potentially other regulators might be a bit concerned about these products is because of one overarching problem that is funding the income for depositors right now. And it's not the issue of, in this case, getting a yield on your assets. No, I bet the SEC would be completely fine with that, so long as they're not protecting the interest of corporate banks in order to mitigate competition. No, I think that their concern is what the borrowers are doing with the depositors' money in order to generate such yield and pay such a yield on those assets. So what could that be? Well, it's the issue that we talked about in our last video, and we've continued to talk about here on the channel for a very long period of time. And it is the issue around leverage in the market. Utilizing crypto assets as collateral to borrow stablecoins and go out and buy more crypto. This is the argument that's been made against Tether and a variety of other assets and how it changes the credit dynamics of the crypto space. Now, I'm going to go ahead and just share my opinion here, so long as you guys get that right. Again, I just want to reiterate here, just so everyone has that context. The idea here, the argument I want to make, is that the SEC is not concerned about the yield potential for depositors. They are concerned about the excess fluctuations and volatility that will be derived from people utilizing crypto collateral to borrow stablecoins from depositors to go out and buy more crypto. All right? I'm going to go ahead and give my candid thoughts on this. I understand very clearly how this does distort markets. For me personally, in this case, I am not a big fan of utilizing excessive collateral nor using it at impromptu times. And I always tell people in this case that if it's for me personally in this case, I recommend people don't really touch, credit in this case in the market. It's just not a good thing for average everyday people. And maybe there's an argument to be made that you have it only for accredited investors. Like, I don't really think that's a smart move. I don't think that's fair in that case. I've been against that accredited, non-accredited argument for a long time that the SEC was built off of for a very long period of time. And we've seen things like equity crowdfunding, which we did for Digifox, were great. Right? We had an equity crowdfunding where everyday people were able to participate in an early stage company, just like venture capitalists would, or angel investors, right? And I think we've seen very clearly that window is, and that kind of, that kind of concept is really falling out now, right? Because your net worth doesn't determine your intelligence. But we can see here that it does lead to some kind of fluctuations in the market. But the important thing to realize is that as it may benefit cryptocurrencies, when there is sell-side pressure in the market, it has just equally of a negative effect, where we get much more reverted to the mean. What do you guys think this sell-off was? For example, for some thought practice here, right? What do you guys think this, close on the day of 11% down for Bitcoin was really drawn by? Was it a huge pile of whales just dumping on the market? No, volume was relatively thin initially on the downside. But then what you had afterwards is you had a variety of other platforms and players having to cover, in this case, for their depositors, right? You had people liquidating these borrowers' positions, right? Having to cover for the depositors, and it causes a bit of a domino effect in the crypto market. That's the issue I believe the SEC has. And look, if the SEC is concerned about this and they want to have some kind of enforcement on it, look, they are the SEC. They're a very important figure within the regulatory space, but their role is deemed on securities, right? And if this is something that they're concerned about, they need to make sure that they encourage the proper regulators to deal with this. I don't think this is a securities issue, guys. So I'm curious to hear what you guys think about this. Again, I'm one person with one thought. But again, it's my opinion. This is going to be a really important conversation we have to have. Do we want to be in the position in the United States where we allow archaic banks, just like in other, authoritarian, oligarchy-based countries, in this case, across the world, to suppress free market competition? Are we going to pretend that banks don't take excessive risk anytime they get the chance to, that they step out of their comfort zone, that they allow for heightened levels of leverage, that they allow for excessive risk? Because to be honest, any risk you can take in crypto in the sense with stablecoins or these borrowing platforms is no further off than the leverage I can go take in equity markets. It's just that it's an earlier market, a little more volatile. Yeah, that's what you get when you have a $2 trillion market versus equities that's an over $110 trillion market in the sense of global equity valuations. It's an earlier market. And not everyone's going all in on crypto. I have to say one thing, and I'll use this as a closing point before we dive into Alchemy Network, which is going to actually kind of dive into this conversation of CeFi blending in with decentralized finance, or centralized finance versus decentralized finance. I have to say that I've actually been someone who's actually spoken very highly of the SEC over the past couple of years in the crypto space. I know a lot of people in crypto, and you'll hear this from a lot of the people out there who are like me, who have that kind of libertarian root to some degree, who are like, let people do what they want to do, right? I'm a big believer, and I actually got to meet the crypto mom in this case, who's one of the major people who are working at the SEC to determine these rules and laws and issuances and enforcements. Not per se the laws in this case, but to enforce the existing laws for securities. I have to tell you guys, I think there is need for regulation in crypto markets like there is with any market. There are problems like wash trading. There is, in this case, manipulative market making, which kind of goes in pair with wash trading. There is, I think, a lot of corruption going on in the NFT space. I think there are a lot of scandalous ICOs, many of which the SEC has hit the hammer down on and protected consumers on, who in this case lost millions and millions of dollars. And they've also allowed a lot of other ICOs, in this case, or token launches, to go out and flourish and do their own thing, right? There's none of these that I'm really like incredibly cautious about in regards to the SEC's moves. They've done equity crowdfunding. They just boosted the limit you can raise for an equity crowdfunding from 1 million a year to 5 million. This is incredible. It's democratizing opportunity. It's exactly what the SEC should be doing, while also being cautionary of the rules that they make. And they've been doing a great job of that, in my opinion. They've allowed the crypto ecosystem to do its thing. But this, as Mark Cuban and many other people have said when it comes to this Coinbase Lim product, it sounds like in this case, right, and I'll go back here, and I think this is the kind of perfect quote here. It's regulation via litigation, right? We do not want to scare or speak down upon companies who are in a very, very positive way innovating and helping everyday people to build better financial products. Because if we do this, the United States will no longer be the hub of tech or financial innovation. As if we were already, so confident in ourselves that we were going to lead in that area. The whole rest of the world in this case is really catching up. And I can say that I've seen that living abroad, how there are many other countries who are building wonderful homes for innovation to be built in. And I have to say, as someone who loves the United States and where I came from, I would hate to see us fail in losing this market in this case that we've been able to lead on in so many aspects. So that's my candid thoughts, guys. Anyways, I've rambled on. Let's go ahead and dive into this interview that is eerily fitting in this case of the topic we're talking about around earned products, Alchemy Network. Alrighty, everyone. So in today's sponsored interview, I'm sitting down with Ryan and Brian, who are two of the co-founders behind Alchemy Network, a project that's aiming to take in traditional DeFi applications into the world of centralized finance and allow traditional third-party industry players to be able to get into the world of DeFi. So I'm going to be sitting down talking with the both of them today, learning a little bit about their story, talking about what they're doing and how they're going about delivering the solution for traditional finance to get into the world of DeFi and all these amazing applications that are coming out. And last but not least, talk about what's going forward. So Ryan, guys, in this case, it's really nice to have you here. Thank you for making the time. And it's always a pleasure to kind of get an update on where you guys are at since we first spoke.
Appreciate you having us on, Nick. Thanks for the time.
Awesome. Yeah, so I want to go ahead and dive into this first topic here, which is talking about what you guys are doing overall at Alchemy Network. So could you maybe give a little bit of context as to what Alchemy is all about? And first off, how you guys even first met in the first place? Because I know, Brian, from my understanding, you're a little bit more in the traditional centralized finance world from your background. And Ryan, you're more focused on the DeFi space. So how did you guys first meet? And really, how did that kind of chemistry come together to build Alchemy?
Thanks. Yeah. So at Alchemy, we're all about really facilitating decentralized liquidity in the DEX space. And a very important aspect of that, we believe, is building on-ramps that allow everyone to participate. So right now with Alchemy, we're focused on enabling institutional capital and users to come on board and kind of bring that behemoth of liquidity into the space. Kind of about Alchemy and how we started. I have an interesting background. I kind of got into the space about 2017. And I noticed some price differences between, Ethereum and Canadian dollar and Ethereum and US dollar, and started building bots and stuff, basically to, make some yield or make some profits off those price differences. And so I had a very interesting enough. I mean, as you probably know, it's called arbitrage trading. Mm-hmm. I had no idea it was called that at the time. So I took kind of like a very engineering approach to here's math, here's the inefficiencies of the problem. So that's kind of how I got into the space. Worked on some solutions there, founded Alchemy in early 2018. We did a early investment round with Outlier Ventures, and then shortly after that, we ended up going to New York City for a Techstars blockchain accelerator in New York City. It was the first one. And it was there, I ran into, linked up with Brian kind of through the program, and, you know, got to meet him and learn a bit about his background working in capital markets and finance. And Brian, you want to jump in here?
Yeah. So I'm the sort of the CFI leader on the team, if you will, turned full degen here more recently. So CFI, DeFi, that's sort of the DNA of Alchemy Network. And my background is quickly, so originally from the US and spent about 10 plus years in capital markets. I fell down the blockchain crypto rabbit hole, if you will, in about early 2017, late 2016. I joined a company called Alpha Point, was early there, saw it grow and scale up to about 130 employees at the time, and had a really good exposure to the entire ecosystem of centralized exchanges and custodians and all these different sort of infrastructure providers on the centralized side of crypto. Noticed that there was quite a few, we'll just call it liquidity issues with some of these platforms that were operating, and decentralized liquidity paradoxes, which could be another way to phrase it. And right around that time was when I met up with Ryan and the rest of the team through Techstars, which was about spring 2019. And from there, we decided to join forces. And that sort of set the stage for what is Alchemy Network now, the CFI to DeFi bridge.
So you guys were saying in this case that you guys had met at Techstars and you had this kind of idea of taking what you guys both know in the traditional world of DeFi, in the sense of Ryan's side, who's self-teaching himself arbitrage, which is pretty crazy. But outside of that as well, you're also taking what you know in this case, Brian, from the traditional CFI space. And I'm curious to hear a little bit more. I don't want to pivot too much, but I'd love to hear a little bit about what some of those liquidity issues were. And I guess we'll maybe dive into that a little bit as we talk about the problem solving of what Alchemy Network provides. But I wanted to hear from you guys, how did you come about actually crafting the concept for Alchemy Network? I think that's a really interesting question.
Well, so I'll turn it over to Ryan here because I think he has a pretty interesting side on this, but I'll say that we, just for some additional color on the problem that we're attacking, unlocking, institutional capital to flow into DeFi, is we both have unique lenses or sort of different approaches to attacking the same problem. Which is unlocking sort of this next wave of growth to flow on chain. So Ryan was sort of the pioneer on driving this, and that's kind of what led to the birth of Alchemy. And then I met the rest of the team and noticed some of these problems, having this experience on the centralized side, and that's what sort of I recognized the timing was right and jumped in on that. So I'll give it to Ryan just to talk a little bit more about the decentralized liquidity paradox.
Yeah. So. Thanks, Brian. The decentralized liquidity paradox is, if you look at decentralization, its job is to separate the concentration of wealth. We don't have a custodian for it. Everyone has their own keys, their own crypto type thing. And then when you look at liquidity, it requires the concentration of wealth. So decentralization by design is separating. Liquidity needs it concentrated for access and market efficiency. So that is kind of like the root paradox of decentralized liquidity and DeFi. And in the past year, especially, or past 2 years, there's been a lot of different projects and protocols working on it. And now we actually have some pretty decent liquidity in the DeFi space, at Uniswap and Aave and these other projects and Compound have brought a mass amount of liquidity into the space, and they're actually pretty efficient now. Like they would rival things you could do on a centralized exchange. The kind of next paradox, or it's not necessarily a paradox, but we're hitting now is, really to get the big money in. How do you get Wall Street in? How do you get banks in? How do you get the global business sector really working and using on DeFi? And so one is the liquidity. And so we're making great progress on that now. There's still a lot more liquidity out there that needs to come in, I think, for them to start adopting. But the other issue really is this kind of compliance aspect. A lot of these funds or banks or others, they have certain restrictions that they can use use to deploy their capital. They need to know who counterparties are, and that they're not trading with certain sanctioned company or countries in the world, based off their jurisdiction. And so how do you now? So now you have this problem of how do you get you solve the compliance, you add KYC and some other stuff to meet these institutional check marks, but then how do you actually get all of these the compliant liquidity working with the incompliant liquidity, or the uncompliant, the non-registered liquidity? And so that's kind of a big issue now.
Another paradox.
another paradox. And then I lost my train of thought there, but
one thing I wanted to build on there in that case, Ryan, is basically the problems you're talking about are the things that are keeping us around a couple $1 billion of liquidity in DeFi versus having trillions of dollars of liquidity. And I think that that's one problem that I've constantly seen people. I think it's a dilemma that people have, or as you mentioned in this case, Brian, it's a bit of a paradox where people want DeFi to be even bigger and bigger, and they really want it to dominate the traditional world of finance. But to be completely candid, whereas DeFi does allow us to kind of play in a world where we play by our own rules, we follow the premise of code on the Ethereum blockchain or other layer ones, and it is permissionless. There is a permission world in this case, and that's where the majority of liquidity is stored. And that's a world that follows regulatory compliance, makes sure you're not only going to have standards like KYC and AML compliance, but also, again, all the intricate factors that commercial banks or institutional financial companies have to think about. It's not so simple as just, they're just going to go ahead and use a single private key MetaMask wallet and tackle into the world of DeFi.
Yeah, and this presents kind of another issue, like when you talk about permission DeFi versus permissionless DeFi. What's great about permissionless DeFi is the composability factor. You can innovate and like, I'm going to build a new protocol or a new financial service that we're going to tap into Uniswap, we're going to tap into Aave, Compound, any of these other principles out there, and they build on top of each other. We've very much been seeing that. The issue is that as soon as you start adding in permissioned gates, this user needs to, be on an allow list somewhere in order to access it. Now you've basically taken away the composability card. So I think kind of like the next thing, and what we're very much looking into and kind of the innovation side and talking to other projects right now, is how do you get, if you heard about like the DeFi Legos of composability and build stuff on top. Yeah. We need the compliance composability. How can somebody that comes in and is compliant on Alchemy tap into another compliance pool? Or how can a new project that wants to become compliant or have access to certain users or meet certain standards, how can we do that? And that's something kind of like we're very much looking at and working on right now with other projects, for the near future.
Very cool. And I mean, in that case, Ryan, it's basically if you want to get the likes of Goldman Sachs or major like financial players into the market, taking traditional deposits, how do you give them the on-ramp to tokenize, in this case, liquidity? So go into stable coins and then go through the proper compliance routes of KYB. And then again, all the other steps of actually making sure that when you actually engage to get that yield, to actually make some kind of margin or provide a yield to your customers, how are you going to do it in a compliant way along the whole entire process? I think it's a pretty big set of challenges, but I'm curious to ask you guys this. So we kind of understand now on the surface, like the obvious issues that lay out here when it comes to traditional enterprise or CeFi getting into the world of decentralized finance. There are going to have to be some permission gates for a lot of players, and they need a streamlined funnel to get them through. So I want to talk a little bit about your guys' first product. It's one of the most obvious ones. It was the first one alongside decentralized exchanges that really excited me when I got into DeFi, really around late 2018, early 2019. And that is the Alchemy Earn product, which is very similar, as you mentioned, to some of the projects like Compound or Aave, where people can deposit liquidity. Other people as well can not only, those people can still earn yield on their assets as they're depositing it, but outside of that as well, obviously the yield is coming from borrowers. So I'm curious to ask you guys, what is Alchemy Earn at the end of the day, and how is it going to stand out against the competition in this case for all those enterprise companies within the traditional finance space?
So I'll take that. So Alchemy Earn at the core is just a borrowing and lending platform fully on chain, powered by smart contracts. So the platform itself is focused on what we call the institutional beachhead or unlocking that wall of money and providing a trusted counterparty experience for institution-grade users to borrow and lend programmatically in the platform, okay? So every user in Alchemy Earn is KYC approved and verified. So there's a process by which you onboard directly. You can go to kyc.alchemy.network. You submit your application. It's a fully automated process. And assuming the user is approved, their wallet is then allow listed, and you're able to borrow and lend sort of on your own basis. It's important to note that it is fully on-chain, transparent, right? Transparent data, and we are not taking custody of the platform, rather, or of the user's funds. It is a pure non-custodial play, picks and shovels approach. Okay, and the reason why these institutions are coming on to Alchemy Earn versus maybe some of the other solutions out there is again sort of back to this trusted counterparty problem, or what we call 3 C's: capital, control, and connectivity. Capital meaning there has to be enough breadth and depth of assets and markets on the platform for the juice to be worth the squeeze, if you will, for these institutions to come in. Control meaning that's sort of that trusted counterparty issue, but really the KYC and compliance, that's a big thing, and then risk management features as well. So being able to monitor their funds, and they're not going to get sort of liquidated overnight. There's a little more of a controlled process around that, so that the institutions can sleep well at night. And then connectivity, there's still a pretty big education gap for many of these institutional players to come into the space. So we've really channeled the concept of money Legos and the architecture of the product when rolling it out. So there's 3 ways you can pipe in. You can come in through our front end via API, or some of our integration white label on-ramps, which is another area we call sort of bridgers, if you will, but piping into downstream CeFi and other infrastructure platforms to unlock institutional capital to flow into the platform.
That's very cool, Brian. So you're basically, what you're mentioning in this case, not only do you have the framework here that's very similar to what people are used to in the sense of on-chain interaction. It's completely, on-chain verifiable. I'm assuming in this case, it's on the Ethereum blockchain, or at least, so it's completely trustless in the sense of on-chain verification. Awesome. Very cool. And the one thing I wanted to ask, because it just actually hit me as we were going through the conversation, I don't want to spend too much time on it, but I'm curious to ask you, for the clientele that you have right now on Alchemy, you've got a good pool, a couple $1 million on the platform, some people utilizing it. One thing I wanted to ask is, you kind of mentioned in this case, about the risk of liquidation, all these different elements. Are you seeing just as equal of excitement for demand for borrowing from these institutional players? I understand that lending and borrowing, they kind of go hand in hand, but I was always thinking that they'd be more interested on the liquidity provision side, or, basically being the depositors of the platform. Are you seeing a lot of interest in borrowing capital from these markets compared to other traditional centralized ways or traditional finance methods?
The short answer is yes. Right now we have, we're around 35 million in capital on Alchemy Earn right now. And that's been driven by the lenders or the liquidity providers. There's a few reasons they're coming on, but the first reason is always sort of the yield, right? The ability to earn high yield interest on your capital or your principal. And on the borrower side, there's, particularly around like stable coins, for example, USDC, there's quite a bit of a shortage out there in the market. So there's always appetite for low cost of capital use cases by which you can borrow different stable coins and, core assets like Bitcoin and Ethereum, which our platform offers in the different markets. So we've seen quite a bit of activity, and especially, going into TGE here and beyond, we expect that to continue to only ramp up.
Very cool. That's awesome, Brian. I'm interested now to ask you guys kind of the big question, because I think Alchemy Earn is a great first product to start. But my understanding is you guys are really going about building an ecosystem here, because once you build, really, I think the core part of it, which is this funnel from getting institutional liquidity from the traditional world into the world of cryptocurrencies, blockchain network, smart contracts, that liquidity is likely there to stay, or it's going to keep getting more and more interesting within the ecosystem as you guys build out more products. So I'm curious to hear from you guys. If you can give me a little bit of information. I understand maybe there's some things behind the scenes that you guys can't talk about, but for Alchemy, what's the next project set that you guys are working on? What are the next kind of usable applications that those who are going through the Alchemy pipeline will be able to actually interact with and be able to get some kind of value or do some type of utility through?
Ryan, you want to take that one?
Yeah, sure. I mean, I touched on this a little bit earlier. The next major thing for us that we're actually working on is the compliant composability, the permissionless KYC, KYB, to work with other protocols and systems to kind of allow, how does somebody who onboards through an exchange that is, tapped into to Alchemy Earn, how can they tap in or use another connected protocol? And how can we kind of facilitate that user flow and open up that liquidity and even liquidity of compliance? I would say that's probably the biggest thing we're working on. It is a fairly complex kind of set of problems to go through, and the hardest part of it is the regulation bounds and some of the stuff just isn't really spelled out. So there's some challenges there just on the business side that we're working through. We've got a lot of great partners and advisors and helping us out kind of go through that and some of the planning and steps. So that's the major thing. I would say on the protocol side, we're looking to implement some staking mechanisms that will kind of help increase yield. And different aspects there. We've been also looking at kind of experimenting with like a fixed rate lending and borrowing on fixed terms is something that we're looking at as well in the near future.
Very cool. That's one thing, Ryan, that, is kind of interesting to me about where you guys are and what you're building, because when I hear the term composability, and to be completely candid, this whole space is relatively new to me in the sense of the composability aspect. Most people are talking about, how do we interact from one blockchain to another, or how do we interact from one layer two to another layer two, having composability of interaction and free moving of liquidity between these different protocols. But for you guys, what you're doing now is saying, how do we have this compliant kind of CeFi on-ramp into DeFi with Alchemy's product suite? And how do we still interact with the traditional world of DeFi? How do we maybe let them still interact with traditional DeFi protocols, but also maybe for liquidity providers, other market participants in the kind of Wild West DeFi world to come into Alchemy's ecosystem in a streamlined and compliant way? Is that what that's what I'm picking up? Is that kind of correct with what you guys are aiming to do with the composability product?
Yes.
Yeah. Nice job paraphrasing there, Nick. Great job. I'll just add a couple things to what Ryan said. So going back to this, what Ryan said earlier, this wall of money, right? Which, if you just to give you a few numbers here, just sort of to put it in context. So if you look at the crypto asset market today, right, we're August of 2021, it's hovering, depending on which day you look at one of the CoinMarketCap or CoinGecko. The market cap is around 2 trillion, right? If you look at traditional capital markets, right, and I'm not just talking CeFi like centralized exchanges, but traditional capital markets, looking at Wall Street and on all the exchanges around the world, fixed income as an asset class in the US alone, market cap is around 100 trillion, okay? So 100 trillion in one country for one asset class. Then if you bring in public equities, private equity, even like different currencies, we're talking hundreds of trillions of dollars in total market cap. So clearly early innings when you look at sort of this, if you think about the digitization of capital flowing on chain, right? Or CeFi to DeFi, but at a much bigger scale, we have a long way to go. So our product, Alchemy Earn, has always been focused on unlocking the institutional capital to flow in. Sort of day one, that's been we call it the institutional beachhead. And then as we go forward and expand here is how can we continue to double down on the product market fit and that we've had so far and scale up and continue to, also channel the DeFi ethos, because we're certainly not in the business of just replicating traditional financial structures or Wall Street on a blockchain, right? We want to continue to push the boundary and innovate. So that's where some of these concepts of digital identity and composability come into play. And if you ask, institutions that are in some of the early adopters in DeFi now, there's a pretty unanimous consent across the board that, the yields are worth it, right? That's kind of what is enticing them to come in. But they also have to think about controls and risk, which is sort of this trusted counterparty problem, and making sure that they continue to be regulatory compliant. That's one big piece. And then the other big piece is just the cost of capital, right? There is a real issue of over collateralization in the space that, the traditional capital markets world, that you can borrow on credit, right? In DeFi right now, you cannot do that, right? And also if you want to lock in a long-term rate, we're pretty early days of that right now. Most of the platforms out there are variable rates. So cost of capital and fixed rates are sort of what we think is some of the next big things to roll out, and we're actively thinking about this right now and ways to continue to bolster our product. And then if you layer on digital identity and sort of pioneering this or doubling down on our strategy of trusted counterparty pools, right? And figuring out a way to make this sort of DeFi passport concept come alive in the broader DeFi community. I mean, that's a big deal. So these are some of the core features that we're thinking about as we go ahead here, and exciting times ahead as we move into Q3, Q4 of this year.
Awesome, Ryan. I mean, that's incredible. And I think that there's 2 points I wanted to hit on. You were talking about the scale of markets, and that's something I talk about a lot on the channel. So, I mean, right now we're sitting, as you mentioned, around like a $2 trillion market cap for cryptocurrencies. And it can sound quite overwhelming when you have a big number like that. But again, as you're talking about fixed income products, I mean, just US Treasuries alone, around like a $50 billion market in the United States. Then you're talking about global bonds, and other fixed income markets. Talking about equities, talking over 110, $120 trillion. So when you talk about these traditional markets, even just getting a teardrop of this market could easily spill in new waves of liquidity compared to the around $70, $80 billion that's locked up in DeFi today, most of which is probably crypto assets in this case rather than stable coins. So I'm honestly really excited to see more tokens getting securitized, more assets coming onto the platform in a compliant way, and coming into the crypto ecosystem. I think it's going to be really exciting to see. So just curious.
And everyone wins with that too, by the way, right?
Exactly. Yeah. No, I mean, 100%. And the one thing I wanted to ask you guys real quick, just to kind of close things off, is, if people want to learn a little bit more about Alchemy and kind of see your guys' vision and follow through things, what's the best place for them to do that?
You want to take that, Ryan?
Yeah, sure. So there's a couple things. So as Brian mentioned before, for anyone looking to test out the platform, get onboarded, or see the KYC process, you can go to kyc.alchemy.network as a business or individual and sign up there and go through that process. If you want to actually see the Alchemy Earn DApp, it's at earn.alchemy.network. And then if you're really kind of curious about the products or interest rates or other things, how things work right now, you could go to docs.alchemy.network for kind of specifications and how-tos and different stuff there as a resource.
Very cool, guys.
And that's Alchemy as in ALKEMI.
Alchemy. Very cool. I'll go ahead and I'll leave a link down below in the description so you guys can check it out and take a good look at the protocol. I think the nice thing, what I like about what you guys have is, as you guys are kind of taking your project out into the open now, you at least already have a protocol launched, you have the assets under management, you have real users who have gone through the existing on-ramp into this ecosystem. So I'm excited to see it grow, guys. Again, I think that, realistically speaking, my goal is to bring more people into better yield environments, bring more liquidity into the DeFi ecosystem. And I gotta say, one thing I'm hoping that you guys do focus on, if you guys continue to build out what you're building, is some kind of automated market maker. Again, I'm a big fan of Uniswap and any kind of AMM. So I'm excited to see what you guys do. I think you guys, if you nail this down and you continue to press forward, I think there's a lot of potential for Alchemy as an ecosystem. So again, for those of you guys who are interested, feel free to check the link down below in the description. But I want to say to both Brian and Ryan on this case, thank you guys for making the time. I know you guys keep really busy, and all the best as you guys are continuing to grow Alchemy as an ecosystem. I think it's really, really fascinating.
Thanks, Nick.
Thanks so much for having us on.
Awesome. Take care, guys.
Thanks, guys.
Thanks.